You don't have the balls to do what I'll tell you to do.
Despite growing up poor in Queens, New York, he became the world's most feared and respected investor. Through intimidation and ruthless brute force, his name sends shivers through corporate boardrooms, unlike any other.
Got rid of the whole 12 floors.
Carl Icahn. We'll first explore his tough early life, then look at what makes his strategy so powerful and why he's worth over $4.5 billion today. Often called a vulture capitalist, corporate raider, and shareholder activist. But one thing is undeniable. Carl Icahn has transformed Wall Street like no other, and is a true investing legend. Part 1. Carl Icahn's early life. 1936, New York. Carl Icahn was born into a low-income family with his mother working as a school teacher, and his father often moving between many jobs. His upbringing instilled discipline and persistence, which would later help define his career. But from a young age, Carl wanted something more, something better. Although he knew it's not going to be easy, he developed an incredible work ethic, but was a loner at school and often fought bullies. His difficult childhood would largely shape the tough and street-smart nature of his character later in life. While being bullied, he finished top of his class and dreamt of going to an Ivy League university. However, his teachers reminded him that nobody from his school had ever gotten into one. Little did they know, this made young Carl more determined than ever. Despite attending a rough public school, his hard work paid off when he got accepted into an Ivy League university called Princeton University. Incredibly, he was the first from his school to do it. But Icahn's parents couldn't afford his education, so he had to find out how to earn money quickly. He decided to play poker. Every day he would study philosophy at university, and every night he would play poker, which would earn him enough to get through university. He had a natural gift for calculating probabilities quickly and could read his opponents like a book. Soon enough, he graduated in 1957 with a degree in philosophy, while having the best thesis out of all students for the year. While studying philosophy, he learned how to think deeply and question assumptions which would benefit him as an investor. Philosophy helped him think independently and ask why things were the way they were, which later helped him make a lot of money. Additionally, poker taught him to think in terms of probabilities and how to read people's body language. These skills would prove to be incredibly valuable for him later in life. Carl Icahn briefly pursued medicine at New York University, but after 2 years, he dropped out and joined the U.S. Army Reserve. After dropping out of university, he was very confused and felt stuck about what to do with his life. He just knew he wanted a better lifestyle than his parents had, which made him begin to admire his very wealthy uncle. With help from his uncle Elliot Schnall, when his army service ended, he got a job as a stockbroker and quickly learned how Wall Street worked. But this wasn't enough for him. He had to think of a better way to make a living, and he knew he could open his own investment company. 1968. Icahn decides he's frustrated with his stockbroker job and quits. He launches Icahn & Company with a $400,000 loan from his uncle. That company would become the foundation for one of the most successful investment empires ever built. Part 2. Birth of the corporate raider. The booming stock market in the 1980s created a new class of investor. Icahn quickly built his reputation by targeting underperforming firms using junk bonds from Drexel Lambert. He often demanded significant changes in management and forced executives to face accountability they had long avoided. At first, companies paid him off to leave, a tactic known as greenmail. But as time went on, Icahn's approach evolved. By the end of the century, he was no longer just feared, he was followed. When Icahn bought into a stock, others rushed in too. That ripple effect became known as the Icahn lift. He became the face of the corporate raider era, and a man who could shake billion-dollar companies with a single phone call. 1979. Icahn's first major victory came when he took a stake in Tappan Company, a kitchen appliance maker. After joining the company, he orchestrated the company's sale, netting himself roughly $3 million. Encouraged by that success, Icahn began targeting larger firms like Marshall Fields and Phillips Petroleum as he viewed them as bloated, mismanaged, and undervalued. His goal was simple: buy a significant stake, push management to sell assets, restructure, or even sell the company itself to unlock hidden shareholder value. 1985. This was his most famous and controversial move, taking control of TWA. After acquiring the company, Icahn expanded aggressively, buying smaller regional carriers. 3 years later, he made TWA private in a stock buyback worth $650 million, which gave him back nearly all of his $469 million investment. But controversially, it also loaded $540 million of debt on TWA. To keep the airline afloat, he began selling off its most valuable routes, which eventually drove TWA into bankruptcy in 1992. He exited the company a year later, walking away with huge profits while the airline collapsed under its debt. Carl Icahn didn't build his empire by playing safe. He made his fortune by targeting undervalued and underperforming companies. But how exactly did he do it? Let's find out. Icahn's approach helped develop the style of investing known as activist investing. This isn't passive stock buying, it's active influence. Activist investors like Icahn use their ownership rights to steer corporate decisions. They can pressure boards, create lawsuits, or make formal proposals at shareholder meetings to spark change. He buys a massive stake in the company, enough to gain influence, and then uses his shareholder power to push for major changes. This can mean replacing management, cutting unnecessary divisions, or restructuring operations. Sometimes these moves lead to job cuts, but Carl Icahn argues it's a necessary reality in fixing poorly managed businesses. Icahn's philosophy is simple. If management isn't maximizing shareholder value, he'll step in and make sure they do. Companies would rather pay him millions than face a full-blown battle. And while that tactic made him one of Wall Street's most controversial figures, it also made him a fortune. Over time, his reputation evolved from raider to activist investor. When asked to define his investing philosophy, Icahn keeps it simple. My strategy, with few exceptions, is to buy when nobody else wants to. Icahn sees value where others see disaster. He searches for companies with a low price-to-earnings ratio or book value far higher than their stock prices. Once he finds a target, he takes a significant stake and pressures management to unlock value, often by replacing the board, selling underperforming divisions, or cutting executives' pay. He's outspoken about corporate excess. Icahn argues that many CEOs are overpaid and underperforming, enriching themselves while shareholders suffer. His public fights often lead to significant change and profit. Icahn's strategy is rooted in value investing, which is essentially the art of finding businesses that trade for less than their true worth. He looks for companies that check a few key boxes. Firstly, their stock price doesn't reflect their underlying assets or earnings. Secondly, they're established companies with consistent profits. And lastly, they may grow slowly, but they're stable and pay dividends. To identify these hidden gems, Icahn dives deep into financial reports, balance sheets, and company filings. He studies them like a detective looking for clues that the market has missed. Once he spots an opportunity, he acts decisively and goes in hard. After the TWA saga, Icahn refined his tactics. He realized that value could be created not only through hostile takeovers, but also by forcing companies to divest undervalued assets or restructure their operations. Icahn would buy large blocks of stock, vote in his own directors, and use shareholder meetings to demand reform. His influence only grew with time, and in the late 1990s, he had a breakthrough. He took a 7.3% position in RJR Nabisco, attempting to break up the conglomerate. Even though his proxy fight failed, he still made around $100 million in profit. Icahn's career is filled with headline-grabbing plays. For example, in 1995, he began purchasing RJR Nabisco stock at approximately $30. The main reason was that he believed its food and tobacco divisions could split to unlock value. 2 years later, Goldman Sachs bought 7.3% of his position, and he made a $125 million profit. That's not bad to say the least. But that was just the start. Next came Marvel Comics in 1996. When the company filed for bankruptcy, Icahn saw an opportunity where others saw disaster. He bought the company's bonds, seized control, changed the management, and became chairman. 2004, Carl Icahn decides to launch Icahn Partners. The company was a diversified holding company that invested $3 billion in companies such as Blockbuster, Time Warner, and Mylan Labs. But even the legends of investing have moments of deep regret. Although his aggressive tactics often paid off, they didn't always. He failed to see that Blockbuster was struggling to adapt to a changing retail environment. Blockbuster's decline was primarily due to its reliance on a business model that relied heavily on physical stores. Meanwhile, competitors like Netflix were embracing new technologies such as streaming services, which helped them achieve higher profit margins. By 2010, Carl Icahn felt he had taken enough of a blow and exited Blockbuster with a rare $180 million loss shortly before the company went bankrupt. He said it was the worst investment he has ever made after he was down around 98%. Despite taking a loss from Blockbuster, he quickly got back up with the company that contributed to Blockbuster's decline, Netflix. In 2012, when most investors had written off Netflix, Icahn saw an opportunity. The stock had plunged to near a 12-month low, and the company's future looked uncertain. True to his contrarian instincts, he quietly bought more than 10% of Netflix's shares, worth about $321 million. When news of his investment broke, the stock immediately jumped 14%. Another Icahn lift. Netflix's board panicked, even taking on what's referred to as a poison pill in the financial world to prevent him from gaining too much control. Basically, a poison pill is a defensive tactic made by a company to deter hostile takeovers. But Icahn didn't need to take over. He just needed to wait. As Netflix grew, so did his fortune. By 2015, Carl Icahn had profited over $1.9 billion from the investment. Few investors in history have pulled off a turnaround of that scale. Icahn was once involved in an incredible fight against Bill Ackman. It was the battle of the billionaire investors. 2012, Ackman's hedge fund called Pershing Square announces a massive short trade in nutrition company Herbalife, calling it a pyramid scheme. Herbalife's stock immediately crashed by around 20%. But Carl Icahn saw something different. He went the other way and bought heavily into Herbalife's stock, eventually owning a little over a quarter of the company's shares. What followed was one of the most public billionaire feuds in Wall Street history. Carl Icahn relentlessly defended Herbalife and watched its stock price climb 51% by 2017. When Ackman finally closed his position, Icahn walked away with an estimated $1.3 billion profit, while Ackman reportedly lost around $1 billion. It was a brutal reminder that betting against Carl Icahn can be very, very expensive. If you're learning something new, feel free to click the like button, because it helps. Thanks. He understands that the market moves in cycles, so he studies long-term trends and pays attention to sudden short-term swings triggered by politics or global events. This ability to recognize where the market is heading allows him to act before others even realize what's coming. He's often said that history repeats itself, and for Icahn, studying market behavior is one of the most powerful ways to predict future opportunities. While Icahn's moves may seem fearless, he's actually a firm believer in risk control. He favors value stocks, which are usually safer since they belong to established companies with solid track records. But he knows this strategy requires patience, as it often takes many years before the market realizes a company's true worth. For Icahn, discipline and long-term vision are what separate gamblers from real investors. In recent years, he has also used his influence for ethical and environmental causes, though his methods remain as aggressive as ever. In 2022, he nominated 2 directors to the McDonald's board, challenging the company over its pork sourcing practices. Icahn, who owns only about 200 shares, accused McDonald's of failing to eliminate the use of gestation crates, which restrict the movement of pregnant pigs. The company fired back, arguing that Carl Icahn's demands would hurt affordability and deviate from industry standards. But Carl Icahn doubled down, rallying ESG-focused investors to back his nominees. His campaign even led the Humane Society to file a complaint with the SEC, alleging McDonald's had misrepresented its commitments. Even here, Icahn proved that influence isn't about the size of your stake, but rather about the strength of your conviction. But even the most feared investor makes mistakes. In 2023, Icahn faced severe criticism after a report by Hindenburg Research accused his firm, Icahn Enterprises, of overvaluing its assets and paying dividends that weren't backed by profits or cash flow. According to the report in May 2023, it alleged that his company was overvalued by more than 75% and traded at a significant premium to its net asset value. Furthermore, the investigation claimed the dividend yield for Icahn Enterprises was around 15.8%, which was the highest among large-cap U.S. firms and wasn't supported by performance. The report mentioned the company's investment results had fallen nearly 53% from 2014. Additionally, Hindenburg Research said that Icahn Enterprises had been funding its dividends with investor capital, drawing comparisons to a Ponzi-like scheme. As a result, Icahn Enterprises stock plunged 20% in a single day, wiping $3 billion from Icahn's fortune and cutting his net worth by $3.6 billion. It was a humbling reminder that even legends aren't immune to missteps. Despite the recent troubles from Hindenburg Research, Icahn Enterprises remains a massive holding company spanning 7 business segments, including automotive, real estate, energy, pharmaceuticals, and textiles. Subsidiaries include Icahn Automotive, Vivus Pharmaceuticals, and West Point Home. What really makes Carl Icahn feared is not just his billions. It's his leverage, timing, and persistence. When Icahn buys in, CEOs know 2 things. He's not going away quietly and will do whatever it takes to unlock value, even if that means replacing them. For Icahn, it's about profit and power. Today, Icahn's fortune stands at around $4.5 billion. Some love him, some hate him, and many fear him. In my opinion, he's a pioneer in activist investing with an incredible ability to profit from undervalued companies. His influence advocating for shareholder rights is helping clean up corporate America. Icahn's actions increase transparency and accountability in corporate governance, leading to progressive changes in business practices. With strong mental toughness and formidable negotiation skills, he's a true legend of investing. If you enjoyed the video, consider watching more fascinating stories here. Also, if you learned something new, click the like button and subscribe so you don't miss out on my upcoming videos. Thanks.